Maria's channel. My name is Maria.
And my name is Maria too.
And today we're gonna talk about the ones that want to buy a house and they are self-employed. As you know, in the previous video, we covered capacity, capital, credit, and collateral.
Yes.
Check that video if you haven't. And Maria today is gonna cover the first one, capacity. So if you're self-employed, take a look at this board.
Yes, we're gonna go into detail about the 4 C's. In this case, capacity. So the capacity is how much money you make, how much you're capable of making payments, right?
Exactly.
So depending on how you report your taxes, it's extremely important that we know that we review your tax returns, we review your bank statements to see how much money you make, how much money you spend, how much money you report to the IRS.
Exactly.
So in this case, capacity, we're gonna talk about self-employed. So self-employed, you have your own business, right?
Right.
So self-employed, you can have your own business, and it depends how much your business how your business reports. Now, what I've seen in the past, or most
With
of
our
our
clients,
clients, the way that it works is we send our taxes, our income to our accountants, our CPAs, and we're like, here it is. This is how much I made. And please make sure I don't pay that much to the IRS because we already paid enough money to the IRS. I get it. And that can help you, but then it can hurt you whenever you want to buy a house, because if you make a lot of money but you write off a lot of deductions, your net income is not going to show enough. It's not going to show that you make enough money to qualify for a mortgage.
Exactly.
You make great money, but then you spend it all and you deduct everything, and now your net income is very little. So in businesses, depending on your taxes, so there's a lot of people that they get paid with a 1099. So if it's a 1099, you probably only have one tax return. On your personal tax returns, you get a 1099. So you'll have a Schedule C, a form, an IRS form, and then it says, okay, I made $100,000 minus deductions.
I'm left with that much.
I'm left with $40,000. And then from that, I would have to see what we can add back. And this is why it's so important that we review your taxes, because there's a few things that we can add back. Just to give you an idea, business miles, we can, depreciation, we can add back depletion. So we're adding back to your net income, and this is extremely important that I review to make sure, or like I connect with your accountant to see like what type of business you do. Can we deduct this instead of that? And that way I can help you. Now, this will be just on your 1040s, right? And your taxes and your personal taxes, because you're a Schedule C. Then you could potentially have your own business or multiple businesses. I have a lot of clients that they have 2-3 corporations. I had a client that had 12 corporations.
Right.
And each corporation, depending how you report it, it could be 1120s. So let's say you do corporation taxes. So that's a form that could be an 1120 or 1120S. I'm not an accountant, but I know enough of taxes.
Right. We do it every day.
Yes, we review them every day. So on your taxes, on your 1120s, you maybe pay yourself with a W-2 because you pay yourself with a salary. A lot of clients pay like weekly, monthly, so you can pay yourself with a W-2. You could pay yourself with a 1099. You could pay yourself with a K-1. So whatever the business makes and pays you as a W-2, 1099, or K-1, this form goes to your personal taxes. So we can review and see how it goes. Now from your 1120s, I can also see if there are other deductions that we can add it back to give you. So for example, a lot of truck drivers, this is a great example. They drive and they have hundreds of business miles because they're driving nationwide.
Right.
And we can reimburse them money for that. I've gotten clients that they have very little net income, and because they have so many depreciation that the trucks depreciate, and they have 100,000 miles that they drive the whole year.
Exactly.
Instead of making, let's say, that 40,000, now they make $140,000 because we added back money, and that extra $100,000 they're not paying to the IRS, but to us, it works for qualification purposes.
Okay.
This is the reason why it's so important that we review your taxes. Usually we require 2 years of tax returns, the most recent ones, so that way we can see, okay, we're gonna do 1 year tax returns, we're gonna do 2 years tax returns, or maybe just get you ready to qualify at the end of the year, meet with your accountant, get you pre-approved and say, okay, this is more or less how much you need to report to qualify for a house.
Exactly. Check out the other videos that talk about other types of
Income.
income, so that you can be knowledgeable and make that decision as soon as possible to be able to get to the dream house that awaits for you.
Yes, that's the key.
See you soon.